So today we're going to go through a presentation that discusses many different alternatives that you have for revenue generation. I want to note very quickly that I'm not a certified investment professional, accountant, or lawyer, so I'm not offering that kind of advice in this. But I do want to say that we're going to be doing some broad, wide discussion about non-traditional revenue sources for nonprofits. We're going to do a brief review of the traditional methods, and then we're going to try to dive into that wide ocean of possible revenue generation techniques. And the goal is to help you ensure strategic financial diversification and stability. So the traditional fundraising is getting donations from individuals, and there's all kinds of ways that you do that: direct, peer-to-peer, crowdfunding, planned or legacy giving, membership dues. There's many different ways that you accept donations from individuals. You also get donations from foundations, corporations doing matching. You might have a gala, your partially deductible donations. You might have temporarily restricted and/or conditional grants. And you might also have volunteers, in-kind donations of time and materials. And we're not going to spend much time, if any, on all of those. We're looking at other types of opportunities. And I want to show you what that looks like. The nonprofit world is about a $3.7 billion revenue stream in the United States. There have been estimates that about 1 out of 7 people works in the nonprofit world. So I want to look at all these other types of concepts that exist in here beyond the traditional ones. And what you can see is there's a lot of fee-for-service happening. So these are hospitals. We also have fee-for-service education, universities. Then there's all these other types of grants and giving. We're going to start with the slightly less traditional donation strategies, and that includes alternative endowment types. We're going to talk about stock, crypto, and donor-advised fund grants, fractional art, real estate, international donors, donations of business and corporations, horses, houses, cars, oh my, if I may. Let's start out with endowments. Most large organizations have large permanently or term-restricted endowments, and they're very difficult for small nonprofits to get. There are a few new techniques, and they're not necessarily very new, but a lot of people aren't chasing them anyway. There's now something called endowed donor-advised funds. You may be getting money from donor-advised funds. They're often used by donors to stay anonymous, but endowed DAFs allow the donors to remain involved in recommending which organizations receive the grants. And it's great for donors who want to have some control, but also remain anonymous, which is fairly common, but especially for large donations. You can also have what's called micro endowments. Often an endowment would be twice your annual budget. That's a lot of money. If you're a $1 million nonprofit or a $2 million nonprofit, that'd be a $4 million endowment. That's not feasible for most small and medium-sized nonprofits. So you can create micro endowments with as little as a few $1,000s. And you might consider doing that. It's revenue generating in that you put it aside in its own special account. You control it. You can still earn investment income, and you can use it in your newsletters as please support our endowment. That can be the seed for something that grows dramatically. There are unrestricted endowments. That's the type that you want most. Some endowments are highly restricted in what you can do with those funds, but you can also attract and create unrestricted endowments. And lastly, there's quasi-endowments. These are also known as agency endowments. And these are created using your own internal funds and allows you to segregate it in a similar way that we were talking about above here. A lot of people are fearful of accepting donations of stock and cryptocurrency. I want to encourage you to look more into that, because this is a way that donors get much more of a tax advantage. If they donate stock and cryptocurrency directly to you, they avoid capital gains tax if they've held those items more than a year. They also get the charitable deduction tax on their returns. Generally, they'll have higher tax savings. So what some nonprofits do is say, no, you have to sell it and then give us the cash. That reduces their ability to get some of these tax benefits. So looking into stock and cryptocurrency donations can be very profitable in that donors will be attracted to you, especially the high-end, high-worth donors. You can accept gifts of art. Now, it's not normally deductible unless the donor gives up the entire interest in it. They have a Picasso, they donate the Picasso to you. And there's reasons that they do that kind of thing. What's interesting and new that you can offer to people is that there's such a thing among particularly the very rich of fractional art ownership. And it used to be that the only way that you could receive a donation of art is if you received the painting or the piece, sculpture or whatever piece of art, you received it and you controlled that. Well, now what you can do is that wealthy investors will own a fraction of that Picasso. So maybe they own 20% of it. Well, they keep 20% of the time in their house. That's what they get for that fractional ownership. Well, they can donate that fractional ownership to you. Once they pass, then you would have that fractional ownership of that piece of art. You can accept real estate donations. I think a lot of groups know about that they can do that. I don't think that they feel comfortable accepting gifts of real estate. Again, they would encourage a donor to sell it and then present the proceeds to the nonprofit. But that's not good for the donor, and it's not as good as it could be for you as the nonprofit. What you are able to do is create a limited liability corporation, and the limited liability corporation accepts the donation on your behalf of the real estate. That single member limited liability company, what single member means is that the charity alone owns it. There's no other owners of that LLC. It becomes disregarded by the IRS. We're going to talk a little more about what disregarded mean because it affects many of these revenue generating options. And what that means is that the single member, you can take donations to that for-profit LLC and they're still tax deductible to the donor because the charity owns that LLC. It's very important for real estate. One more thing on real estate. One of the main reasons to accept real estate is that it is an excellent vehicle for having collateral if you want to get a line of credit or loan. But you can also just use that real estate, build something on it, use the space, whatever it might be. There's a lot of reasons to be willing to accept real estate donations. International donations. A lot of small, medium-sized nonprofits fear international donations. And international donations have two pieces. One, the money comes from outside of the US to you, or money from wherever you use overseas. Donations from overseas are often tax deductible to US donors who reside overseas, and it may be tax deductible to donors who are citizens of other countries. What is important is those donations from overseas cannot be specifically earmarked for a foreign entity. So in other words, if you have a German donor to your American nonprofit, they can't say, I want that money to go to Kenya. You have to have sole control and discretion over those funds. There are some international rules about anti-money laundering, and you would need to follow those. We're going to talk a little bit about that. You can't be a conduit for funds. So let's say that somebody came to you and they were from Jalisco and said, I've got $20 million and I'd like to make a donation to you. You need to raise an eyebrow on that and think hard about it, because you have to maintain full control and discretion how those funds are used. So it's wise on especially large or unusual foreign donations to do a little due diligence, to vet them, and particularly against the anti-terrorism and anti-money laundering regulations. But there is a lot of money overseas, and a lot of money goes from international donors to Americans, and sometimes the American charity moves that back over to overseas projects, such as a school in Kenya, for example. Perfectly legal and very common. Also, another way to do it is you can be a friend of a nonprofit that is overseas. So those movements of money, the technical term is friends of, they can create a 501c3 counterpart, or you can become a counterpart from another organization. Sometimes these are franchises. In essence, they're like franchised type organizations. And there are a lot of international programs where the donor can give US registered nonprofits. Foreign charities can also have 501c3 status, and you can be affiliated with them so they can get their own 501c3. Instead of using your 501c3, they can have their own, and you can become sister charities. Last but not least, there are intermediaries out there, such as CAF America and DAF Giving 360, where they will facilitate donations from international donors to you and make sure that all the anti-laundering paperwork and IRS bureaucracy is all accounted for and correct. And that money just comes to you free and clear. So working with CAF or DAF Giving 360, give them a call. Find out if your organization is somebody that they are looking for as a recipient of donations from overseas. Donating a business or corporation. it is perfectly legal for you to accept a donation of a business or corporation. And again, this can be highly advantageous to the donor. Maybe the donor has owned a business for 20 years, they want to retire. They're doing something similar to what you do. Maybe you're Save Puppies and they are working as their organization also helps dogs. They would fit directly under your operation. You can accept that corporation as a gift. You would record a large gift from the donor, which could affect your public support percentage. We're going to talk about what that is in a moment. But often that can be eliminated as legally as you think through how that donation will happen. And there are tax implications for such a sale that you would need to think through. But that can be a very lucrative way to bring in a variety of assets is by accepting the donation of a business or corporation. You can take donations of just about anything that's legal. My suggestion is working to convert most of those to cash if you're not going to directly use them. So if you accept a car as a donation, then work with a group that turns that around for you. They turn that around, they give you a percentage, they take a percentage, and then it goes on to the auction block, and you don't literally own a car. We're going to talk about a few new laws that have come out and how they affect nonprofits. These are very important changes. This is a big year for nonprofits in California. The first is there's something called the California Nonprofit Equity Initiative. If you haven't heard of it, I suggest looking it up. The whole point of this is to improve the cash flow for nonprofits, make sure that there's more timely payments, and to protect your funding eligibility. We're going to talk about what that means here for just a moment. The mandatory advance pay, AB 1039, is going to have a massive impact. Effective January 1, all new state grants and contracts have to offer you advance payment. And that advance payment can be 25% of the whole. So if you win a $4 million contract over 4 years, you could ask for $1 million of it before you even start work. And it's intended to help with costs like hiring and equipment. They must now explicitly state in their RFPs whether they are offering that advance pay option. So look for it. Prompt Payment Act expansion, AB 880. This legislation extends the Prompt Payment Act to all state contracts with nonprofit. They also now have this Prompt Payment Act expansion. This piece of it says that they have to promptly pay you. How many people out there have had state contracts and it's taken 6 months to get paid? You're basically making a giant loan to the state. They recognize that. They're going to stop doing that. They can do partial payments. So if they disagree with a particular timesheet, they can pay you for everything except for one piece of it. But there's even rules about that part of it. The other piece that's new under AB 880 is that now they're going to allow for standardized indirect cost coverage. And what that means is that you can use, if you happen to have, this is primarily true for larger nonprofits, but you can have a federally negotiated rate and the state can just accept that on face value. They can also allow a standard state approved rate. Why is that important to you? So many nonprofits out there, when they get state, county, city, any kind of government contract at all, they lower their indirect rates, either intentionally or unintentionally, to the point where it's not profitable anymore. And some nonprofits lose a great deal of money on government contracts. They're in effect subsidizing the government. The goal behind California's rules about this is they don't want to ask nonprofits to subsidize the state anymore. You would have to get unrestricted funds then to make up that difference. And that's been a challenge for California nonprofits for decades. Use these new laws. If you get that 25% mandatory advance pay, call up your bank right then. All of a sudden you're flush with cash and you can use that as a line of credit that is collateral for a line of credit. You can also immediately build a cash reserve and maximize your liquidity in a larger way. Just read the fine print of the contracts, but that can be very helpful to you. You want to speak with your contract administrator to see what exactly you can do, but often this can be very advantageous to nonprofits. Unfortunately, today is May 14th. There were 2 ways to get money. I'm just going to tell you about them because I want you to watch for the next iterations of these. Cal Money Smart was accepting applications through today. If you're really fast, maybe you'll be able to apply for it. I don't know. But these are financial empowerment grants of up to $200,000 per year. This particular cycle allows for a 15% indirect cost coverage. The other one Also expiring today is the State Nonprofit Security Grant Program. This is where you could apply to harden yourself as a potential target from hackers and others. And that could be a significant amount of money that they were allowing you to use or giving to you to make your systems more secure. Indirect rates. We've talked about this a little bit, but this is a great way to increase the amount that you are paid, whether it's fee for service, whether it's a government contract, a commercial contract, whatever it is. A lot of nonprofits don't understand indirect rates, and often they underbid, and then a year later, they're wondering why they're losing money constantly. It's very important to understand your hourly and other billing rates. You need to scour them. You've got fringe rates, overhead, general and administrative, you've got fees, you've got other direct cost markups, subcontractor handling fees, and other fees that are available to you to use when you bill, especially government contracts, but also private contracts. You want to know what your competitors' rates are and be competitive with those competitive rates. What that means is if they're using a 15% fringe, well, there's no reason for you to be under 15%. Understand what those rules are. You can often get those competitors' rates by requesting them from the state, for example. You can request the winning proposal often. Sometimes it annoys state administrators, but it's perfectly legal to put in a FOIA request for your competitors' proposals. You need to know when and by how much you will lose money. If you want to lower your rates because you want to win, then you need to understand how that's going to affect you. How much are you going to lose? How much are you going to have to subsidize those contracts? And then if you, on the other hand, increase your fees and you make some money on it, which is perfectly allowed and appropriate, you should decide at the beginning of the process, what will you do with those excess fee margins? How will you use them, ideally in unrestricted mission critical type programs? The 990 is a money-making opportunity. However, nonprofits do them wrong most of the time. Most nonprofits could really improve their 990s. Why is that more important now than it's ever been before? Because a lot of the largest grant makers right now are using AIs to review the 990s of applicants, and 990s going back years. And what the AI is finding is that things are illegal or incorrect or bad, however they want to decide on it. And so where a human might have looked at it before, now the AIs are catching these errors. So what can you do to improve that? Right on the front page is your program impact statement. Don't write it so long that it carries over to Schedule O, because then people aren't looking at it. Make sure that it's concise and complete right there in the front. You can put additional information elsewhere, but just realize that people are less likely to look at all those. And make sure it's about your impact, not about your programs. There's a big difference between the two. It's very important to be able to check off. These three are mentioned specifically inside of the 990. You need to make sure you have all three. They are not required by the IRS. They are recommended by the IRS, but they are often required by grantors. Make sure you have a conflict of interest policy, a whistleblower protection policy, and a document retention and destruction policy. You should have those. They are not hard. You can get them off the internet. You can get them from your lawyer. Have them so that you can check off those boxes. Another place that people make a lot of mistakes on the 990 is in Part 8, 1 and 2. And that is how you separate donation versus services. Nonprofits often misunderstand that. Remember, a nonprofit can fill out the 990 themselves. You don't have to, there's no rule that you have to have a tax preparer do it for you. Even if you use a tax preparer, that tax preparer is going to rely on you and how you say these things are to be parceled out. So understand the difference between donations and services and fill out Part 8, 1 and 2 correctly, because that's someplace that AIs are now looking. Really understand the overhead myth. The overhead myth is that if you have overhead higher than 25%, you're not efficient enough. That is simply a myth. There are nonprofits who are doing great with 1% overhead. Maybe all of their cost is in buying food and their administrative cost is 1%. Maybe they are at 50%. They absolutely have to have all of that to do the incredibly good work that they're doing. But people look at it. So when you fill out Part 9, the Statement of Functional Expenses, Be sure that you are doing it where you understand how the costs are being allocated to the different categories. It's very important that you meet cash versus accrual and the auditing and the committee review standards. Some of these are legal standards. If you're over $1 million in California, you have to be audited, and that means you're going to have your books done professionally. And there's rules about what committees you have to have as a nonprofit in California if you are being audited. There's also the difference between cash and accrual accounting, which you have to switch to at or it is preferred that you switch to once you hit $1 million. You should understand all of that, and it's complex. So I happen to be a fractional COO CFO, and it's a big part of my job, helping nonprofits figure these things out because so many people are doing it incorrectly. Last but not least, be sure you are reporting to California correctly. That RRF1 that's often stuck at the end of the 990 from your tax preparer, you need to submit that every year, and you need to submit the fee associated with it. California is now going after people, and you could lose your California status for not doing that correctly and timely. Okay, we're going to switch topics entirely here to one of my favorites, lobbying and advocacy. All of you are doing advocacy. It is just a natural part of what a nonprofit does. If you are feeding hungry children, then you are out there advocating that children should be fed. But there's a whole constituency out there for what you are doing, almost anything that you are doing, that are really fearful and really angry. And they want to see that you're lobbying. Lobbying is a subset of advocacy. It's just a type of advocacy. What is lobbying? And I'm going to explain why this is a money-making venture for you in just a moment. Lobbying has three major limits, very generically defined. That you're communicating with decision makers, for example, elected officials and their staff, and you're talking about existing or potential legislation, and you're urging a vote for or against it. Depending on the government entity, you would have to do all three to be categorized as lobbying. You would need, LA Metro is a government organization, and if you're standing in front of them talking, not at their invitation, but yourself, you're talking to one of the board members about this, that could and would be considered lobbying in many cases. And Metro happens to be one that has very difficult rules, but others are very simple. The simplest, by the way, is the federal government. Why would you possibly want to be doing lobbying? You've got children to feed. Why would you want to be lobbying? Well, there's some reasons that are in your benefit. There's a saying in DC that if you're not at the table, then you're on the menu. And I really believe this is true. If you're not out there advocating and lobbying for your cause, then somebody else is, or at least they're lobbying against you. If you're working with lobbyists and you're doing lobbying, you're often the first to know about opportunities that exist at the state, the local, the city, county, whatever level it might be. If you're lobbying, then you're talking to those people. You may be hiring professional lobbyists. Their job is to know about these opportunities before anybody else knows about them, which means you can either help craft the direction that they're going, or you can apply right at the beginning because you knew about them. You can befriend supportive leaders who are ideal connections. As you are lobbying, you are becoming friends with these politicians, state representatives, etc. They are beginning to see you as a person they can talk to about these things. And this is where it comes to the donations. You are inviting a whole new class of donors. And that is the very angry out there and the very fearful out there. They want you to lobby, and they're looking for a voice to express that anger and fear. So by you accepting those donations, you can address that group. There are lobbying limits. So let's say that you are a $2 million nonprofit. You get $2 million a year. Under your 501c3 status, you can spend $250,000 on lobbying. The rules about what is considered a lobbying expense are a little bit complex, but you can do it. Lots of nonprofits do it. No matter what, please get your H election. It's one of the easiest things that you could possibly do. It's one form, one signature. You send it in, you're under H election, and the rules for lobbying are so much better for your nonprofit. And if you ever get into a lawsuit or an audit with the IRS, if you have the H election, your life is much simpler. It's the easiest government form that there is, and carries no risk to anyone. Some nonprofits out there have decided to create they're C3s, and they've decided to create sister agencies, which are C4s. C4s can do unlimited lobbying, no limit to it. They can use every nickel they want for lobbying. They can be the advocacy or lobbying arm of a C3. That can be a really good donation generating, revenue generating option to have a sister organization, which is a C4. The accounting of that is complex. You will want professional accountants to be helping you do that and for it to be set up by lawyers. That's a complex piece, but it can be very good at generating revenue. Question I get occasionally is a group will have space and a politician would like to use it as part of their campaign. They want to come in and use their gigantic conference room to talk to their constituents. The IRS has said that you can do that. It's not participation in the political campaign. If you were participating in the political campaign as a C3, you could lose your C3 status. But they have said in this case, you can rent to a politician and make money off of that under one condition. You have to be making that space available to everybody, and it has to be available to the opponents of whichever politician you are renting it to. So you could say, hey, dear politician, we're using space. If you would like to use it, it's $10,000 for the space. As long as you are offering at the same price to both candidates or all candidates, you're not going to fall afoul of the IRS rules. The finance market-based revenue options. It's very important that you understand risk, liquidity, and fiduciary responsibility. And many boards of small nonprofits and medium-sized nonprofits do not know that. You have to understand FDIC and SIPC insurance, but you have so many options. Okay, this is a pretty little graphic. We're not going to go through it in any depth, but basically you have options for your money that include using it internally, low risk but low return, but it's instantly available, all the way up to high risk and volatility, but possible high active returns. You have a whole bunch of options in here. Interest-bearing accounts, cash sweeps, certificates of deposit registry service. This is a type of cash sweep. Federated treasuries, again, can be set up as a cash sweep. Brokerage investments, loans, lines of equity, and annuities. So those are some of the examples that we're going to talk about in just a moment. I do want to tell you what a cash sweep means. If you have over $250,000 in a bank, whether it's in multiple accounts, whether it's in one account, whether it's a CD or a checking account or a savings account, the total amount of $250,000 inside of a bank, if you have more, it's not insured. Only $250,000 is insured. So that will show up in a lot of people's audit statements. The auditors will say, you are not insuring your money because you keep more than $250,000 in a particular bank. What a cash sweep means is the bank assures that you don't ever have $250,000. They move the cash overnight to other banks. It's still yours, still liquid. You can still move it back at will. You can control it. They have little dashboards that you can move it back and forth. You can define what banks you want. And the different types of investments determine your income, your interest rates. But you can have interest rates that are 10, 15% on an account that looks like it's 1%. So your checking account and your saving account may have nothing. Your checking accounts may have 1%. But you can use these cash sweep concepts and similar type of concepts to get much higher returns on your money. Those funds are insured because they are in another bank. Now we're going to talk about earned income. There's a lot of concepts under earned income, and we're going to go through every one of these real quick. First, I want to say that people worry about earned income because they're worried about the 33% rule. So here's what the 33% rule is. At least 1/3 of your support over a rolling 5-year period must come from the public or from mission-related program revenue. It has to be related to what you are doing. It's 1/3. Now, you could have 100% in 1 year that's not mission related, all right? But over 5 years, the average has to be 1/3. Now, what does that mean? That means 2/3 can come from non-public and non-mission related sources. That's incredible. When you think about that, that's mind-blowing. 2/3 of your money can come from anywhere else. Well, legal, anywhere else. Doesn't have to be related to your mission. It doesn't have to be from the public. Now, if you fail that test, then you could be reclassified, have to pay taxes, and then they could even put tighter restrictions on you. So you don't want to fail the test. And it is reported on your 990. That's where it's tracked, that rolling 5-year percentage of 33.5%. It's important to watch, but it's actually really difficult for you to fail. Almost all the money you're getting is related to your mission somehow, but it doesn't have to be. So let's talk about some ideas on how you could earn outside revenue. You can charge for workshops and training. You can have program fees. So sometimes that's related to your program, but it doesn't have to be related to your program. You can do consulting. You have expertise in your nonprofit that can be used elsewhere. You can offer that expertise at a price to other businesses and other organizations. You can sell merchandise, t-shirts, tote bags, whatever you want. You can operate a store with in-kind donations. Now, those in-kind donations and that store would not be considered, because the IRS has rules about it, would not be considered unrelated business income. You can rent out your space, your office desk, meeting rooms, event facilities. There's lots of startups and freelancers and others that might just want a desk or a conference room or something else. You can rent those out. If you own cars or a fleet, or you own significant equipment, you can charge for the use of those. You can rent them out, in essence. Also, don't forget to get intellectual property. Use your copyrights, use your trademarks, and you can sell the licenses to those, including data, research products, proprietary frameworks, a lot of different ways that you can sell your intellectual property as a nonprofit. Here's one that a lot of nonprofits do, and they do it illegally. So we're going to go through this real quick. You have options to provide gaming opportunities, gambling opportunities to the public. The main three are raffles, bingos, and casino nights. And these are highly regulated at the state level, but lots of people do them. You have to register to do these. It requires $100, and you have to have been around for 3 years before you can begin gambling, using gaming and gambling. There are strict rules about them. There's also rules about how you report on expenses and income and money that comes back through. So you need to check on those. But I'm just going to do the big three for you. Poker nights. You can do one poker night per year. It can't last more than 5 hours. It cannot have cash prizes, and it must have a strict and limited value of prizes. But you can do it once a year. And sometimes a poker night can bring in a great deal of money. People love poker nights. Bingo. This is a type that is exempt from unrelated business income tax. We'll talk about that in a moment. But there are specific rules that apply in the state of California. Raffles. This is the worst one, okay? This is the one that most people are doing incorrectly. You have to register every raffle at least 60 days in front of the advance. So what do I say? Why am I saying that sometimes people are doing it illegally? It's because at galas, they think, oh, we're going to sell tickets. We're going to have a drawing on those tickets. Well, that's a raffle, and you have to register those, and you have to report that on your 990. So please be careful about these. But all three can generate a great deal of revenue if done correctly. Quick note on these, because I get asked this, no one under 21 can participate in any of those things. There are prize limits. Please keep good record keeping on all of these. Fiscal sponsorship. You can have entities under your entity, and they pay you to be under you. That's called a fiscal sponsorship. What you would do is you would be selling services to other nonprofits or other projects, and the services you would be selling are like accounting, human resources, tax compliance, and you can charge them. Typically, it's between 5 and 15% of all the funds that they raise. There are three main models of this. You can kind of look through this, but the main concepts here is that under models A, B, and C, the sponsor receives the charitable donations. You, as the sponsor, receive those charitable donations, and then you grant it down to those other organizations. It can be a project that you have. So a project would be a group that says, I don't want to become a 501c3, but I'm doing great things in my neighborhood, and I need someone to help sponsor me. So you sponsor that project. It's related to your mission, which can be widely defined as your mission. The money comes to you, and then you basically pay for that project. Or it can be separate. The project can be a separate entity different than you. It can also be, in another set of models, an entirely different corporation. And there's reasons you want to do this. An example, what we talked about earlier, was real estate. But a group could be wanting to do work, and they create themselves as an LLC under you, where you own 100% of that entity, but there's a shield between you. And the funding sources can go directly to that project, to that limited liability corporation, but they get the tax donation, the tax deductibility, because they're under you as a sponsorship. That project is using your 501c3 status. Perfectly legal, happens all the time. You can own a for-profit, and a lot of groups do this. An example is a hospital. A hospital's mission is health, but maybe they want to have a gift shop inside of the hospital. Well, gift shop has nothing to do with health. You can't, it's hard to imagine how you would equate gift shop with health. So what they do is they create a corporation for the gift shop that is solely under the hospital, right? And the hospital gets all the profits. There's a lot of ways that this is extremely useful to nonprofits. Well, the main rule is that anything that happens from those earnings, they can't go to private individuals. It has to go to a parent organization. And that for-profit can't dominate the nonprofit. It has to be a subset of the nonprofit. Usually, because you are tax exempt, you might be generating unrelated business income. So you have to be careful about that. But don't let it stop you. Don't let taxes stop you. If that for-profit can generate $1 million and pays 100,000 of it as taxes, you still get $900,000, right? The tax implications shouldn't be the reason you make a decision not to create a for-profit under yourself. You get liability protection for doing that. You can generate revenue that would otherwise be unavailable to you. And you can attract investors. People can invest in that for-profit. Now, the whole concept of that for-profit is that you want them to be a disregarded entity. What that means is the IRS isn't regarding them. It's not that you're disregarding them. It's that the IRS says they are disregarded for the purposes of taxes. They are wholly owned by the 501c3, and it's reported on your 990. Okay, so that finances get consolidated in the parent's Form 990, but you still get the separation of liabilities, which is wonderful. There are commercial factors to consider so that we can keep moving here. Just make sure you understand the pricing, the marketing. You have to be concerned about how much you're competing then with the for-profits in the area, and that for-profit can't use volunteers. They have to use paid staff. I've said this many times. I've used this term, unrelated business income. What does that mean? It means that things that are not related to what you do and could be considered you doing something for profit, those could be subject to tax. If too much of your income and time and resources are related to that, then they could remove your 501c3 status. So you want to be careful about it. But it's usually 15 to 20% of your revenue and time is related to that unrelated business income. However, if you only did it once, then it wouldn't meet the regularly carried on test because you would be subject to that tax and possibly risk losing the 501c3 status only if it's regularly carried on. So it would have to be frequent, continuous, and conducted commercially. There are lots of exclusions to unrelated business income. If you used voluntary labor for it, that's not subject to unrelated business income. If it's just a convenience, for example, you offer a cafeteria as a hospital, that's not going to be subject to the UBI. If you're using and selling donated items, for example, through a thrift store, that's not subject to it. Anything passive, dividends, interest, annuities, royalties, all these kinds of things, that's not subject to it. And then certain corporate sponsorship payments are not subject to UBI. So these are all great just to bring in pure 501c3 revenue. Please feel free to do them. Royalties. You can charge royalties. You can charge royalties for people to use your name, for people to use your logo. If you create educational programs, you can sell those. You can create films, TV, and have acting performances as a nonprofit. And you can license those materials and those events to others and generate revenue that way. Music, radio, live streaming, mechanical rights, TV, film ads, all that kind of thing. Anything that you patent, a lot of nonprofits don't patent things, but if you did, you could sell the use of that patent. You can copyright literature that you create and therefore sell it. And you can create software. If you came up with some great software program that helps you, you are welcome to sell it. And these can often be treated as tax-exempt royalty income. That's the joy of being a nonprofit, is this tax-exempt royalty income. You can merge with other nonprofits. Yes, you can. Absolutely. Happens all the time. So if a nonprofit is going out of business, either because the founder's leaving, just doesn't want to bother running a nonprofit anymore, or maybe they went bankrupt, whatever it might be, they're dissolving. You can absorb them into you. And there's a lot of reasons to do that. It can significantly increase your assets, your name recognition. You can get more staff expertise. Big one is donor data. You can assume all their donor data. Use all those things. We're going to go on to how can you make money that makes you sound like a bank. Something called program-related investments. A lot of small nonprofits cannot get loans. You can offer loans to those nonprofits. That's called program-related investment. As long as their program is somehow related to you, you can give them low interest, you can do loan guarantees, even equity investments, as long as it's related to generally what you were doing. And there's a real tax benefit to the recipients of those. When they pay back those loans and that interest that they're paying you, it is recycled to other loans. Right? So it's a process that you can use to generate revenue for yourself, pay for your own staff, that kind of thing, and do great good in the community because you can be offering loans to people that otherwise would not be qualified. There's mission-related investments. That's the opposite. This is where you're saying, we're going to invest something, and it's not going to be necessarily good for our particular community. So you are looking for competitive financial returns. It's often done through existing brokerages. And there's a real benefit to doing this from a fiduciary responsibility perspective. So look into mission-related investment opportunities as well. Here's just a quick chart of what the difference is. For example, for a program-related investment, you'd probably be getting below market returns and the capital's repaid. On a mission-related investment, you're looking for market rate returns. You can set up a charitable gift annuity, right? So this is where a donor transfers assets, typically your cash or appreciated securities, to you as a charity, and you in return pledge to pay a fixed guaranteed income back to the donor, called a charitable gift annuity. Upon the beneficiary's death, everything that remains belongs to the charity. You can offer immediate or deferred gift annuities, and the downside is you are legally responsible for making the payments regardless of the investment performance. Okay? You can partner with a small nonprofit can do this by partnering with community foundations to help liability. You can look up some information about that on philanthropy.com. The California Department of Insurance requires that you have a certificate of authority if you do this, but it's a perfectly legitimate way to bring in a great deal of assets, and sometimes quickly. There are ways for you to get direct cash payments as tax credits. Okay, so you can be part of the whole trend right now of solar panels, battery storage, etc., and you can receive payments for that type of work. That can all be done legally. You would file a Form 990-T to claim those payments, but it's something for you to look into. How do you decide which investment opportunities to go after? All those things that we just talked about, how do you decide between them? Well, there's a lot of ways that you are looking at it. You're looking at the financial viability. How much pure profit is it bringing to you? You're looking whether that opportunity aligns with your mission and with you're deciding is a social return on investment. You're looking at how much time, staff time, for example, or other internal resources you would need to use this particular. We have 1 minute left. So these are some of the other things that you would look into. I am not going to go through the rest of it. I so appreciate everybody who has joined us. I hope this was helpful to you. And I'm available to answer questions going forward. And then please contact me if we can help otherwise.